4 behavioral patterns that can destroy even experienced traders: chasing price, revenge trading, overtrading, and cutting profits too early. 4 behavioral patterns, if left unchecked, can slowly destroy even experienced trading accounts over time. Those patterns include chasing price, revenge trading, overtrading, and closing profits too early. Many traders don't fail because their analysis is wrong. The real damage comes from the same destructive behaviors repeating over time. And the dangerous part is that this doesn't just happen to beginners. Even experienced traders fall into it when those behaviors stay unchecked. Chasing price. The moving train. Chasing price happens when a trader enters after the main market move has already happened, driven by fear of missing out instead of a system-based signal. This behavior often leads to entries at the worst structural points, near the end of a move, close to support or resistance, with uncomfortable stop losses and poor risk to reward. This behavior creates risk for 2 reasons. Late entries force stop losses to sit too far away, or they push traders toward placing stops unrealistically close. In many cases, the market pulls back immediately after entry, which turns the trade into a stressful position from the start. A system-based solution helps prevent this. The trading plan should clearly state that if a setup gets missed on the first touch of a level, no trade in the same direction is allowed until a new setup forms. Adding a time-based or candle-based rule also helps, such as invalidating the entry if more than a defined number of candles has passed since the original signal. Revenge trading. Getting the money back at any cost. Revenge trading appears after a loss or a series of losses, when focus shifts away from executing the system and toward recovering money. In this state, trades open to soothe emotions rather than to follow structure. Several warning signs usually show up. Position sizes suddenly increased compared to normal, trades open quickly after a loss with little analysis, and internal dialogue starts sounding like that loss needs to be recovered right now. This behavior becomes dangerous because risk increases while setup quality drops at the same time. The statistical edge of the system and proper risk management collapse together, and the result often becomes a chain of deep losses that can damage a large position and portion of the account in a short period. Clear system rules reduce this risk. A forced stop rule helps, such as stopping trading for 1 day or 2 after sessions with 2 or 3 consecutive losses. Defining a maximum daily or weekly drawdown also matters. Once that limit gets hit, trading stops, even when a great opportunity appears. A pre-trade checklist adds another layer of protection. If simple questions like "does this match the defined setup" cannot be answered calmly, the trade does not get taken. Overtrading. When the market gets forced to give opportunities. Overtrading means trading more than logic allows. That can show up as too many trades in a day or a week, excessive risk per trade, or both happening at the same time. This behavior usually comes from a mix of greed for faster profits and discomfort with waiting. Several signs make overtrading visible. Trades open without a clear setup just to stay active. Timeframes get switched constantly in search of any signal. Limits on daily or weekly trades get ignored. This behavior creates multiple problems. Hidden costs like spread and commission pile up with higher trade frequency. Decision fatigue sets in, and weakens analysis quality. The account enters a cycle of sharp swings, and real risk control disappears. A system-based fix works here as well. Set a clear cap on trades per day or week, such as maximum of 3 trades per day or 10 per week. Define specific time blocks reserved only for analysis and journaling, and allow trades only when every checklist condition gets met, without exceptions. Cutting profits too early. The fear of losing what isn't locked in yet. Closing profits too early happens when a trader exits a position before price reaches a logical target, purely out of fear of a pullback. At the same time, losses often reach full stop size or stop losses get adjusted repeatedly. This behavior creates a clear imbalance. Losses hit their full size while profits stay smaller than planned. Over time, the real risk to reward ratio collapses and system expectancy breaks down regardless of what looks good on paper. This pattern usually comes from focusing on whether the current trade ends well instead of focusing on executing the system across a series of trades. Fear of watching open profit turn into a loss also plays a major role. System rules reduce this behavior. Define minimum risk to reward ratios in advance, such as 1 to 2 or 1 to 3, and follow them at the system level, not trade by trade. Use partial profit taking to reduce mental pressure, for example closing part of the position at the first target and then moving the stop on the remainder to break even. Regular performance evaluation also matters. Checking the average win versus average loss inside the trading journal quickly reveals whether profits consistently close too early. Which of these behaviors feels more controllable through system rules? And which one feels more psychological? Share one clear thought in a single line.